Hello everyone, and welcome to Strategy.
This is a series of videos explaining business strategy. Today, it's corporate strategy. Let's start again by the definition of strategy. Remember what a business is? A business is a product and a market. Using this definition, we can develop a notion of corporate strategy. Then, we can use this definition to distinguish the three levels of strategy. At the first level, we have the business level strategy, which is one product and one market. Then we have the corporate level strategy, which is several products and several markets all together under the umbrella of a corporation. And then we have the network level strategy, which is the interaction between different corporations. Today, we're going to speak about corporate strategy. At this corporate level, the objective is achieving the optimal configuration of businesses under the umbrella of the corporation. So what's the shape a corporation typically takes? There are different business units that here we have pictured as SBU1 to SBUN. SBU stands obviously for Strategic Business Unit. And each of these business units operates under a corporate umbrella. Now, how do you get to have different business units under a corporate umbrella? The key word here is diversification. You start adding products and adding markets. And the more products and the more markets you add, the more you add to diversification. In order to manage all this, you develop a corporation that manages all of the business units. So the key word here is diversification. Diversification leads to multi-business and leads to corporate strategy. There is a very clever way to describe how diversification happens. If you're entering a new market with an existing product, then you're developing the market. If you're entering a new market with a new product, well, that's genuinely diversification. If you're entering an existing market with an existing product, then it's market penetration. And if you're entering an existing market with a new product, then it's product development.
This clever 2x2 is called the answer matrix. Diversification can be related or unrelated. Related diversification refers to an additional business unit that is related to the current business of the corporation and that capitalizes on the current expertise, know-how, and capabilities. Related diversification is reflected in the old saying that says, stick to what you know. Now, unrelated diversification is the opposite, is the additional business that doesn't relate to the current business or businesses we have. Related diversification makes more sense because you're supposed to leverage the capabilities that you already have. But there are many companies that are not necessarily investment companies that do unrelated diversification. Typical examples of this are GE and Tata. A related concept is the concept of integration. Integration refers to one corporation adding another business into their portfolio in such a way that is vertical or horizontal. Horizontal integration is taking over another firm that operates in the same level of the value chain. So if you're selling lemonade on the street, you're buying another company that sells lemonade on the street. Vertical integration is a different thing because here we're taking over firms' operations that operate across the value chain. So, for example, a supplier or a buyer. Typically, if you're buying a supplier, that's called upstream. And if you're buying a buyer, that's called downstream. The purpose of integration? Horizontal integration helps companies expand their size. They buy competitors, and by doing that, they're able to increase their output, increase their market share, and expand into new markets. Why do we vertically integrate? Because you want to boost profits or have more control over the production line or have more control over the inputs and so on. Now, corporations happen all around the world. In this slide, you will see examples of corporations. that occur everywhere. If by any chance you don't recognize the name, I would invite you to Google the name, and in doing so, you will exercise your research skills. I'll give you a minute to make a note of the different companies on the screen. Remember the value chain? Well, the value chain can be separated into the key primary activities. And this is what we've done in this slide. You can see that each activity is followed by the previous activity. I have separated the value chain in its component activities to give you an example of how a corporation can operate with a fragmented value chain. So let's discuss Apple. This company outsourced many of the activities of the value chain. Yeah, of course, they do the R&D, they do part of the purchasing, but they don't do any of the production. The iPhone 12 will be totally produced in India by Wistron. Then, of course, they're into the marketing, but the distribution is done by somebody else, like UPS or FedEx. And then they go back to the service to which they do a part of. This is an example of a fragmented value chain, where the company has chosen to carry out some of the activities of the value chain and has outsourced others. When a corporation has multiple activities, multiple product lines, and multiple business units, they need an all-encompassing framework that will allow them to coordinate and manage all these activities. The standard tool for portfolio analysis is called the BCG Matrix, and this is a 2x2. There's a very similar matrix called the G Matrix, which is a 3x3. Today, we'll cover the BCG Matrix. The BCG matrix is nothing but a 2x2 matrix which on the horizontal axis has the relative competitive position, which in plain English is the market share. And on the vertical axis, it has the growth rate of the industry, which is another way of saying which part of the lifetime the industry is. Is it a young industry, a middle-aged industry, or an old industry? When we put together these two axes, we find that there are 4 quadrants. And the Boston Consulting Group has chosen catchy names for it. What really matters about the BCG matrix is that when you're able to put one of your businesses in one of the quadrants, then it means that the decision is pretty obvious. So for example, if you have a cash cow, the associated decision is to milk the cash cow. Milk the cash cow for what? To use that cash for stars that can be perhaps future cash cows. On the other hand, if you find that you have a dog, what are you supposed to do with dogs? You're supposed to divest them, which is the same as selling them out. Interestingly, this means that a dog for one corporation will not be a dog for another corporation. And then what happens with the question marks? There are projects that are being developed and R&D, and they could either become stars and shine, or they could become dogs, and then you need to divest them. What has been for many years the key question in corporate strategy? Well, whether you should have business units under a corporate umbrella or not. Think yourself, you may have opinions about this. In general, the economists and finance people say that that is not the right thing to do. And in general, corporations are discounted in the stock market. However, in strategy, we have a different view. And this is, if you put different businesses together and the value of the businesses together is bigger than independently, then there's a justification to have a corporation. And how do corporations create value? Through synergies, which is how costs and benefits from one business can be transferred to another business. Now, this is a big debate and maybe one that you want to inquire further. Now that we're finishing with corporate level strategy, let's compare it with competitive or business strategy. The business level strategy will always be important at the strategic business unit level, whilst the corporate strategy will be important at the corporate level. The question of corporate strategy is how to create parental advantage. So how do you keep all the businesses together in such a way that they are more valuable together and separated? And on this note, we finish with corporate level strategy.